Hey, everyone. Thanks for tuning in to another episode of the What Matters podcast. I'm here with my co-host, Ashley Ward. And today we are interviewing our guest here, Mr. Brian O'Neill. Brian, I'd like to take a few moments here and, step off my soapbox and, talk a little bit about your origin story. And first and foremost, how did you build your RIA?
Well, Mike and Ashley, thank you for having me first and foremost. I would say I built the firm very intentionally through the years by focusing first and foremost on financial planning. So I still believe that's a differentiator in how we treat our clients. The RIA industry, I know, has a lot of folks who put themselves out there as financial planners and financial advisors, but we live that every day. I'm almost evangelical about using cash flow and tax projections and the entire holistic approach to treat clients, whether we're investing for them or not, in a way where they're getting answers based on the entirety of their financial lives, not just on portfolio or just on insurance. So I started the firm in 2009. I had been in the business for 13 years, working for, I guess, what I would call a regional firm that had been purchased by a bank in 2001. So I give the founders of that firm a ton of credit. They taught me the model that I still use today using financial planning. And I would argue when they started their firm back in 1988, nobody was doing financial planning. People were still trying to figure out how to sell real estate partnerships after the change in the tax code in 1986. So they gave me a really good foundation to understand what I thought was important. I would have been a lousy broker, a lousy salesman. I needed to be able to serve people. And so that stuck with me. Our company had been owned by this bank for 8 years, 8 years, and then the financial crisis happened. And needless to say, being owned by a bank was less than pleasurable. I was kind of running our operations at the time, and instead of being able to focus on my clients, I was spending a lot of time getting called to the mothership of the bank and figuring out how we could cut expenses and increase revenues. And that just really became something that I found onerous, and I felt like there was a better way out there for me. And we were a hybrid advisor, probably serving as RIA 98% of the time, but every now and again we could sell insurance or we could put people in a trail mutual fund. So in 2009, I took the leap and left and became a fee-only RIA and started Cahaba Wealth Management.
Wow. And we'll highlight on that in just a second. I'm going to get slightly off topic here. 2009, what a year to decide to go out on your own, right? Can you tell us a little about that?
It was intense. There's no doubt about it, because if you know kind of how this business works, you certainly have to have an infrastructure in place. I began planning this really in late 2008 while the financial crisis was literally on top of us. I was an officer of my company. I was the vice president, so I had a fiduciary duty to the company and my clients, so I could not do any of the planning during the day. So I basically had two jobs all of 2009, which was to be a financial advisor and run the firm I was at while going home at night and planning the exit and starting my new firm. So it was challenging, but I would say I didn't really open my doors until the middle of November. And by that point in time, we began to see, I guess the corny phrase was the green shoots, that maybe this, the world wasn't going to come to an end. And the truth is, a lot of my clients had encouraged me to think about this because they were getting frustrated with the bank ownership and some of the constraints placed on them by being part of a bank relationship. So my clients were incredible during this. I mean, I'm sure if you've talked to enough people who have started their own RIA, you are asking people to take a massive leap of faith. You're putting them through some challenges. They're opening accounts and moving information and literally in some cases starting from scratch because I couldn't take information with me. So I had to start the financial planning process over. So it was a challenge. But, in hindsight, I've told people this before, it was the most exciting and terrifying time of my life, professionally. I mean, other than having kids. So, it was a lot, but it's been very rewarding. And I look back and could not have been more pleased with the decision.
And when you say that owned by a bank. I know that you began your career at Bank of America in 1995, I believe.
Yes.
Is that the bank owned that you're talking about? Or
No, it was a different bank, and at this point, there's no sense in throwing people under the bus. I don't need to put names out there, but it was a regional bank in the South. And when Glass-Steagall changed in 1998-99, and banks could go from just making money off of loans and interest, and they could get fee income in the form of insurance or investment products. A lot of banks began trying to cobble together the thought process, but I think the key term there is that they cobbled it together. I don't think there was a real philosophy around how to incorporate firms like ours into a bank model where, the bankers ended up viewing us as a threat, because if we do our job right, we're going to replace 95% of what any banker does other than loaning money. Every other decision that relates to financials should come to us if we're doing our job right. So it wasn't a wonderful marriage. It's not like they made our lives miserable, but they didn't bring us a lot of clients. We were just a standalone entity that happened to be owned by a bank, providing them some net income while really not adding a ton of value on the financial planning side to us.
Gotcha. And thank you for that answer. I appreciate it. And so let's delve into the next question here. Entrepreneurial learnings, what are some of the valuable lessons you learned along the way? And, some invaluable lessons to help aspiring, some wealth managers navigate challenges and see some opportunities here?
I mean, honestly, I think the first thing is that level of intentionality. And I look back and I don't know that I actually had as much intentionality as I like to think I did. There's a reason my name is not on the door. I wasn't interested in creating something that was about me. Again, I know I'm a servant in many ways. Our clients hire us and continue to keep us as their advisor because we serve them in a really important way. Financials are super personal. Other than your marriage, your money is about as personal as it gets to any individual.
Yeah.
So the idea of, if you're going to leave and start your own firm, trying to plan ahead, what do you want to be 5 years from now, 10 years from now? Because this business can, in many cases, and there's nothing wrong with it, but this business can turn into just a lifestyle practice. And you get a certain number of clients, you're happy with that, you got a staff of 3 or 4 or 5 people. But then what happens? What I have found, I was very nervous about the concept of growth for the sake of growth. What I've learned, and I learned it by bringing in people, and actually because we grew almost in spite of me, growth is a necessity because it gives opportunities internally. And if you're not growing, you're not allowing for talented people to come in and become part of your organization and strive for something. They're just there holding a seat until they find something better to do. So after creating a partnership, so I founded the firm, but I now have 3 partners, and we have spent years developing our mission and our values and a culture that we can live by. I've been able to get comfortable with the idea that growth actually is to let us serve more people, not just to get big and get our name in, publications and get on the news and all that stuff. It really is at the core of who we are, is to serve people and be that trusted advisor. And if we can serve more families, amazing. That's fantastic. It provides opportunities for everybody else at our firm and can provide income for, the owners and partners.
Gotcha. Yeah. You said something about, it being very personal to people. And I know it on both ends, right? Because, having, being in the same space as you, right? I also have my money with a wealth manager as well. And I spent, probably the better end of the 6 months of last year and the first 3 months of this year, that whenever I'd have a meeting with my financial advisor, I would say, I don't want to know how much my portfolio has gone down. I don't want you to talk to me about my portfolio until I was back up to where I was when I first started with you. Yeah. Right. And because last year, I got beaten up pretty bad. I was in,
everybody did.
Yeah.
In my 27 years, that was the worst single year of being an investor. That sounds crazy, but we more espouse a keep it simple approach on the portfolio side. The truth is very few managers actually beat benchmarks. We index quite a bit in order to keep costs low, to keep tax efficiency high. Thus, we get somewhere near the market. But by doing that, last year, both stocks and bonds went down, and bonds had the worst year they've ever had. So if you have that traditional, boring old 60-40 portfolio, you had a worse year last year than you did in 2008. So,
yes.
yeah.
Sorry to
You
interrupt
just
there.
have to live through it.
Yeah, and I didn't mean to cut you off there. You highlighted on something. Last year, stocks and bonds both went down. Can you share a little bit about that? Because that's out of the ordinary.
Oh, it's completely out of the ordinary. In somewhere roughly around 100 years of history prior to last year, that had happened 4 times. So we just booked the 5th. And when part 2 of that is that bonds had the worst year they've ever had, it really makes it a challenge, because we preach the idea of portfolio balance. And if we own bonds, they will be there to save you when stocks struggle.
Right.
They weren't last year. Now, if you maintained it, not just bonds, so even within your fixed income portfolio, having some level of cash, having some level of shorter duration, it at least helps you muddle through that, where you didn't end up blowing up a person's portfolio and having to sell things that were off 15 or 20%. But really, I read somewhere, and this sounds silly because, as somebody who's in this industry, to think that there might be 112 asset classes, kind of makes me want to chuckle. Like, what the heck are y'all talking about? But I think I read somewhere, one of the big brokerage firms, big banks, tracked 112 asset classes, and 4 of them were up last year. So you either had to own cash or oil, or some strange combination of 2 other things. Otherwise, you lost money. There's nothing you could do about it. So, more of that is about leaning on your plan and saying, at least if we went into that knowing how much you should have taken last year, or at least some ballpark of what you should have withdrawn, and where we would have taken that from, we would have been sort of in advance of that. And if we had shorter duration stuff, we kept any losses to a minimum. Thus, we give this year the chance to happen where stocks are up 20%. Bonds are still basically flat this year because the 10-year seems to want to continue to go above 4. But you still had a much, much better year this year. And it really, to us, investing is all about having enough flexibility to make it through whatever stuff the market is going to throw at us. And it's going to throw a lot. And last year was about as bad as it got.
Yeah. And so let's get into this, because this is something that I've been, very curious of regarding Cahaba. The secrets to Cahaba success, and primarily your success, what are some of the best secrets to building your firm?
I would argue it's not a secret. It's almost the most basic things on earth. But that idea of having a culture, it sounds corny. It really does, and I get it. And before we put it into practice, I looked at it with a bit of a skeptical eye. But it's not just having a culture and creating words that say, this is our mission and these are our values. It's going through a really deep process. And we spent multiple years with an outside consultant, and I would recommend utilizing outside people for that kind of stuff. It's not easy if you're a sole practice. And by the way, are you going to consult to talk to yourself? No. It's once you build up enough of a group of folks where you're like, all right, we got to communicate with each other. We hired an outside consultant, and she's guided us through a process of really learning about each other, meaning the partner group, and then learning how do we communicate with everybody else? How is our communication received by everybody else, so that we can create a culture that is built around healthy conflict. If we need to bring conflict, we can bring it in a way that is not undermining the overall organization, because, when you spend 40, 50, 60 hours a week with any group of people, you're going to have some conflict. And the first thing you have to realize is you can't just bury it under the rug. And so that sounds simple, but we've built a culture where our hiring decisions are built around people who we think will fit our value system. And then our, reporting and monitoring of employees is built around, first and foremost, are you living our company values? And if you begin to stray from that, it's a very clear signal that this is not somebody that is going to fit long-term and going to let us achieve our mission, which is to serve more families and institutions and really in that serve word, it lives very high in our culture. So it's, and it really got me pausing during COVID because all these companies said they don't want their people to come in anymore. You can't have a culture if your people aren't in the office. And I
Right,
get it.
right.
I understand the idea that people want flexibility, and we don't squash our folks' flexibility. If people need to work from home occasionally, we're certainly willing to do that. But you cannot have a culture if people don't interact with each other.
I'm in 100% agreement with you there.
So
Yeah.
we've really spent a lot of time. We've spent money on that, and it's hard to spend money in areas you don't feel like are productive. It's the single best dollars we've ever spent.
Yeah. My twin brother, who's one of the managing partners of our company, 7x7 Capital, was his primary focus throughout pretty much the better end of our business partnership is culture, right? And the problem that we faced is we had partnered with people in the past that didn't believe in culture, and we had a business partner that said, how about at the end of the year we put $500 in an envelope and give it to everybody? That's your culture, right? And so, there was an alignment amongst the business partners there, and you can't have, half the business partners agreeing that culture is important and half of them, not giving two craps about it, right? So,
no question. And furthering that, you have to have your staff has to believe that you believe in the culture, because
right.
If they think it's not authentic, it doesn't matter if the partners are all on the same page. If that can't trickle down to your staff and they believe that you guys really believe in that, you're not going to get the buy-in. We're going to put our folks together next week. We're actually taking an annual kind of retreat. We're taking our whole company down to Florida, and we're going to spend the first morning doing a book club on a book called Legacy. And it's a very simple read, but it's really fascinating what it digs up in, what are you doing here? What is your why for wanting to be a part of this organization? And our why is about serving people. Does that why trickle down to our staff, and do they treat that with the level of importance? Because if your staff doesn't treat it the same way, your clients are going to pick up on it. They'll know they're getting, half-ass service, or, they're just not getting treated at the level. We want to treat people with white glove service and make sure they know that every financial decision they're going to get a full review of everything, and they know that that decision is coming from a place of a fiduciary standard and understanding their situation.
And when you talk about the why, is that from Simon Sinek's practices?
It's actually in that book, Legacy. You'll probably find it in a million different places. I mean, they reference Maslow's hierarchy of human needs. Like, what is your purpose on Earth? That sounds kind of broad and ridiculous, but if you don't understand why you're doing something, it's just a job. It's not some sort of true vocation that you buy into, and then you have an employee, not a employee owner, and somebody who will treat your firm like it's their own. And that becomes our next step, is to trickle ownership down to the other people in the firm, and we're working towards that as well.
That's great. And so let's get into this next question here. What I would say, what does the future of wealth management look like?
That's an easy answer. Financial planning. I still say if one of the big brokerage firms would be willing to sacrifice their P&L for 12 quarters, they could own the world. They won't do it. They can't do it. Their CEO would get fired by the time they went through the whole project. But if you can train, a group of brokers, and this is not to crap on brokers. There's plenty of really good people that have jobs in the brokerage world. They treat people as well as they can. Their model is broken, though, and it does not allow a level of service that, unless you are trained and you are capable and then willing to spend the time behind the scenes to understand a client's situation. That means understanding their tax situation and understanding the kinds of insurance they might need and their risk profile and their cash flow. What is their income, their expenses, understanding that tax piece. That takes a lot of time and energy. And we, the only people we're going to sit in front of clients have CFP designations. That's a 3-year process for most folks. That's hard. It's something many people don't want to do. And even like folks who are breakaway brokers still are really primarily just focusing on investing people's money. So we take clients from that group of folks every day, and we don't lose a lot of clients. I say that, and I don't mean it to sound obnoxious. We keep our clients because we treat them super well, and we dig so deep in their situation that not only are they clients, that their kids become clients, their grandkids become clients, and we retain those relationships. And it's all because we do deep financial planning. That is the future of the business. It's actually the present as well, but it's just really hard for some folks to do it. Some people either don't want to do it. The time and energy required is difficult. The investment to do it at a firm level is incredibly large. We got approached by a bank about 4 years ago, and they said, "Why don't we just buy you?" And I was like, "No chance. I can't. There's no chance we could do that because they would not put the time and energy into doing it the way we think is doing it." We've got a phrase. Our catchphrase is "There is a better way," and we really believe that. We believe doing deep level financial planning is a better way than just being a broker or a salesman or anything else that's more superficial.
Gotcha. Thank you for that answer. Here's one that I'm pretty interested in hearing your take on this. Artificial intelligence. How do you view artificial intelligence, and what do you think it's going to do to impact the industry?
Well, first off, I would like to thank you for thinking that I'm a lot more bright than I really am. The fact that you would even ask me that question. I haven't got the slightest idea. I understand the basic tenets of artificial intelligence, and I could see it potentially being a very big part. For example, our investment portfolios are really rules-based. We are not out there trying to make a qualitative decision about owning this stock or this fund because, I don't know if you're familiar with the data that's been put out there now. I think we have about 20 years worth of data, and I'm absolutely drawing a blank. Can you all pause for a second? Let me come
Absolutely.
back to what is the SPIVA? All right, I'll start back. So I'm not sure if you're familiar with the SPIVA scorecard, which is S&P index versus active. They now have 20 years worth of data comparing the performance of active management versus benchmark indices, the S&P 500, S&P 400, 600, and the like. Something in the neighborhood of 96+% of all mutual funds and active managers don't beat their benchmark over a 20-year window. And the idea that we could select a fund that going forward would do that, and that manager would still be there 20 years from now. I mean, the amount of hubris that requires is pretty intense. So instead of doing that, we just accept the reality that indexes are generally better. We will actively manage in a couple of more esoteric asset classes. Foreign still has a lot of potential alpha. Some specialty classes do. But in the U.S., you're hard-pressed to find anything that's going to beat the benchmark. So we don't spend a lot of time doing that sort of stuff. We just focus on the rules. And so if the portfolio is out of balance, we sell stocks. Oh, that means we've sold high. If they go too low, we buy stocks. Oh, we bought low. So AI, I suppose, could add value there. It could certainly keep me from having to write articles about stuff. But otherwise, I just don't know. I'd love to tell you I do. Where I do think, what I can say with confidence is that a human being is still going to be important. I did a pitch one time to a board of directors to do investment management. Well, number one, it's not really what we do because we couldn't do financial planning for a foundation. All we could do is invest their money. I knew I was probably at the risk of not getting that business anyway. But after going through our investment proposal, one of the guys in the room raised his hand and said, "Hey, what's to keep us from just taking this stuff and doing it on our own?" And I said, "Nothing. Anybody can take indexing and do it on their own." I said, "However, I challenge you to look around this room and get a consensus in March or April of 2020 that it's time to buy stocks." You wouldn't have done it.
Right.
And by the way, the rules said you should have, and then the rules would have told us to sell again in October. But human beings are miserable decision makers. We just are.
I've always thought the best way to phrase the decision making when it comes to humans, because look, I'm guilty as well of not selling something when I should have, and buying something low watching it go up and then watching it go back down below the price that I bought it at. Right.
Yeah.
And you know, I'd like to say, like, gosh, I can't believe I've done something like that. But, you know, when I've brought it up to other people, they're like, oh, don't even bring that up. That's a sore spot for me. You know, I wholeheartedly agree with you, because I do think when April of 2020 happened, and what was it? The market was down 40%. Everybody was comparing it to 2009 when the market was down 70 or 80%. And they're like, well, the market's got another 30 or 40% to go, right? Not knowing that, you know, they were going to buy 40%, at a 40% discount, and
Yeah.
they were going to double or triple from there.
Well, I think, you know, I feel fortunate. I stumbled on some stuff years ago, probably about, I'm guessing about 10 years ago, maybe even more than that. But Michael Lewis's book, The Undoing Project, you know, he was famous for The Big Short and Blind Side, and I mean, Liar's Poker. For heaven's sakes, he predicted the financial crisis in 2008 when he wrote Liar's Poker in 1987. But The Undoing Project was about the data and the research that led to things like Moneyball, where you're making decisions based on data, not based. The human gut is the worst decision-making vehicle the world has ever known. We're terrible at it. That's why managers don't, I mean, professional managers, their emotions overtake logic. And so it helped me. And there's a reason, I think, that today, I think as of about 3 years ago, the Certified Financial Planner's curriculum has a behavioral economics module to help advisors know, look, most of what you're battling is your client's terrible decision making. And if we can bring more rules to it and more logic to it in a way that still makes sense to them, you can't just, you know, act like a robot. But our portfolios are a lot more built for that. And again, back to the AI concept, I could see maybe, you know, you could utilize AI to really keep an eye on your portfolios in a more granular way and be able to trade and things like that. The biggest challenge we've had is turning trading, you know, the trading of those portfolios into a more ongoing regulated process. It's still very manual comparatively, and the softwares that are out there they're okay, but they don't really answer the big picture question of how to do that in a super efficient ongoing way.
Gotcha. And so let me get your take on some exciting investments. What investments and sectors are most exciting to you right now?
Well, if I could play the sound of disappointment, it's what you would hear right now, because that's not what we do. I would not remotely tell my client that I have an exciting investment for them. In fact, I will tell them the opposite. I am here to bore you to wealth. Wealth is a process and a much, you know, significant time investment on your part to wake up and realize you have money, but it's based on your behavior and your decisions, not on selecting the next Amazon. For every Amazon, there were, you know, hundreds of pets.com and every other piece of garbage in 1998 and 1999. And, you know, most people thought Amazon was just a dumb bookstore. So again, it goes back to human behavior. We are not in the business of selling sizzle. Our clients understand that our job is to help them make very difficult financial decisions with whatever limited information they have. And here's a good example of that. I have a client, and I've referenced these clients before in a podcast we did. I know they know who they are, and they've given me approval to talk about them without using their name. This was March of 2020. These are clients who do very, very well. It's a high-level executive at a corporation, and the couple, you know, is making 7 figures together, doing very, very well. We invest their money for them, any excess that they don't put into 401ks and deferred compensation and stuff like that. But again, it's indexing. It's the same thing we do, basic blocking and tackling. So in the depths of March 2020, they had made a decision to buy a condo apartment in New York City because they love it up there. They like to spend time up there and could not, they were paralyzed. I can't do this. And you know, I heard the words, New York City's never going to be the same again after COVID. And after I stopped laughing, you know, and this was during COVID. It was one of the good laughs I actually got during COVID. I was like, come on, New York City is going to be New York City. And it's not because I knew we were going to make it out of COVID the way we did. I just know that the human being is hardwired to, you know, run for safety. And these clients were on the edge of not making a decision. I said, look, I've been doing this forever. I've run all your numbers showing the market has already fallen 40%. Your numbers still look good. And by the way, if you have to work one more year in order to afford this apartment, wouldn't you want to do that? So I walked them through that. They bought the place. Since then, they've actually flipped into a new place that was twice as expensive as that one. And every time I talk to them, they say, they don't say, gosh, your investments are awesome. I love that thing you just put us in. They say, thank you for helping us understand that we could afford this place in New York City that has been the single biggest value add in our lives, other than having our kids. I mean, that's the kind of stuff that we help people do. We don't talk about the sizzle and the sexy investment. So the best investment that we put people in is the S&P 500. And I'll live by that.
Oh, wow. Wow. And let me ask you this. When it comes to the economic outlook, what do you think is in store for the economy? There's a lot of questions out there regarding our debt load, near term and long term.
And I think that's legitimate concern. It's by the way, it's not going to change our investment philosophy. I can't know what next year or next 2 years holds. I can say overall, I still think that the United States economic system is the greatest generator of wealth and bringing people out of poverty the world has ever known, as long as we don't mess with the tax situation too terribly. And right now, it's not. I mean, I know people don't like when taxes get raised. The truth is the Trump tax cuts if you really know the tax code, it didn't cut taxes for most people that were making a ton of money. It saved them a little bit of money, but then they lost out on the SALT deductions. There's other taxes that are added in from Obamacare surcharges, things like that. It really didn't change the tax code dramatically for most people. As long as it doesn't go so high that it disincentivizes work. And we're nowhere near that. I mean, people forget that in the Reagan years, before Reagan took office, the top marginal tax bracket was 70%.
Really?
Oh, yeah. Our top marginal bracket today is 37, and there's not a soul that's paying an effective rate of even 37. It's an average rate in the low to mid 30s. You can add state taxes and other stuff into it, and perhaps you can find your way to 50% or something like that. I still haven't seen a single human being go, that's too much tax, I'm just not working anymore.
Right.
So, I when I look at the economy, I still think there are challenges. Our debt load is a problem. With the Fed raising rates, the debt service amount is going to squeeze out productivity from other areas. We have to be aware of that. And that's just economics 101. We only have X dollars coming in. And if last year it cost us $200 million to service our debt, or billion, and this year it costs us $400 billion, that's $200 billion that can't go somewhere else. So as long as rates stay higher, and it feels like the market has finally agreed, rates are going to stay higher. We couldn't stay above 4% until the last 3 weeks. And, with the most recent economic reports, that still show a lot of economic strength. The jobs number last Friday was the first kind of, whisper that things have certainly at least slowed down and maybe slowing down more. The debt is a problem, and it's one of those where, again, I'm just not smart enough to give you an answer. I worry about it. It's not going to make me invest differently and change my thought process, because one of two things is going to happen. We're either going to figure it out, or we're all going to live on a ranch in Montana, and we're not going to have anything else to worry about anyway. So I can't get so worked up. I mean, I have some clients that it paralyzes. I'm like, guys, what do you want to do about it? You want to bury all your money in the backyard? That doesn't help. So, we do what we can. We try to be as logical as we can. But in general, things tend to work out.
Yeah. So burying your money in mayonnaise jars in the backyards is
not on the top of our recommended list. Yeah.
So, I got one final question here. What do you see as the what does the future hold for Cahaba? Do you guys plan on growing the company? Do you plan on selling the company, or what's your guys' plan there, if you don't mind me asking?
Not at all. No, our plan is to grow and sustain. We have 19 people, and I hope in 10 years we have 3 times that amount, and I hope in 20 years I'm nowhere near this place because I'm already 51, and I hope that our team is still doing everything that we do to serve people. Again, I mentioned there's a reason my name's not on the door, because it's not about me. It's about our clients and if you build the right culture, it's about your staff and your team and wanting them to have those opportunities as well. And it's a strange dynamic. There's a lot of debate these days, obviously, with the stuff going on with BlackRock, and there's certainly questions even about the fiduciary standard of what they're doing by placing stakeholder value first. What's different at a private company, we can place stakeholder value first and not be violating some fiduciary standard. And ultimately, I believe very firmly it leads to better outcomes. If your staff thinks that you're in this for something more than yourself, they're going to want to do some heavy lifting and they'll go that extra mile. And so our goal is to grow this firm, but grow it the right way. We get approached a lot, both by people who want to buy us, and we're like, thanks, but no thanks. And additionally, we get approached by people who are looking to join, and we said, okay, twice to smaller additions because it's so important for our culture fit to work that usually we take so long examining a potential addition that they may have found somewhere else they were willing to go before they even finally make a decision they could join us. So we're okay with that. We're trying to speed it up a little, but we cannot sacrifice our culture purely for the sake of growth. So I'd love us still to be here 10, 20, 30 years from now, serving people and doing it in a way that's meaningful. And sure, I'd love to be a lot bigger because that means we're serving a lot more people.
That's great. Well, gosh, on every podcast I do, it's very rare I walk away learning something. And, you said a couple things earlier that I can't stop thinking about and resonating about the humans, how horrible we are at making decisions and how bad, making a gut decision is. And I never thought of it like that, and it just,
it simplifies things in a way that's pretty profound for our industry. I personally felt responsible for what happened in 08, 09. That is not healthy. I felt bad for my clients. And, I still today, if that same thing happened, during COVID, I felt bad. Like my clients lost money, but it wasn't my fault. And, I was doing everything I could to serve them in the best possible way. But if you are an investor, you are going to take those hits from time to time. And, yes, Abby Joseph Cohen called the 1987 downturn. What's she done since then? She's made a living off of one call, and she got lucky. So that's fine. More power to her. But I don't want to base my decision-making on guessing what happens next. What I do know is that stocks go up. Hard stop. So as long as we can live with that and, have a plan in place where we understand what our clients need, where it needs to come from, how we would get that, no matter what the market conditions are, then we're going to be meeting our duty to serve people well, and it creates great relationships. There are people that I work with, and I absolutely call them friends, and I didn't, there's some friends that I work with, but there are people that were my clients who have become friends, and that's pretty powerful. I love what I do, and I love what we have a chance to continue doing, and I hope people in our industry pay attention to that planning side and really working on becoming holistic advisors.
Well, thank you. I really appreciate your answers to all these questions today. I wanted to thank you again for taking the time out of your day to be a guest on our podcast. Till next time, everyone. Brian, thank you once again. And we'll look forward to talking with you very soon.